What's going on, everybody? It's Curtis here, and we have a bit of a different style video for you guys today. I've just recently gotten into trading, and I found a fantastic strategy through a great mentor, and I've implemented it into the crypto markets. And it's versatile. You can use it in almost any market. So if you're into Forex or stocks, whatever it may be, it works in these markets. I just like to trade crypto, as my time is basically booked Monday through Friday, and the crypto markets are open 24/7, so I can capitalize on getting some extra trading in, and as well as, perfecting my skill. So I don't want to waste any time. I want to get right into this video. I want to keep it short and simple. Personally, I've watched tons of videos in the past where you're stuck watching a 20-minute long, strategy video, and it's just gets too long, too boring. You lose interest and you lose, the basis of the whole video. I don't want to be that person. So we're going to get right into it. The first thing you're going to need is to add a couple of indicators. You're going to need the 14 exponential moving average, the 50 moving average, the 200 exponential moving average, or EMA for short, and your Fibonacci tool. So what you want to do first is probably get your Fibonacci tool. You want to mark these levels down and make sure these are the levels that you have. So it's a 79, well, your 100 and your 0, those are the default levels. Then all you want is your 79% level, 70.5% level, 62%, and your 38.2 level. Those are all you need for your Fibonacci tool. And, without further ado, we're going to just head over to the chart and get right into the video. Okay, so this is what your chart should look like after you've added those EMAs and the 50 EMA. You can change it to whatever colors you want. I just want to clarify that the green EMA is our 14 EMA, the red EMA is our 50 moving average, and the purple moving average is our 200 EMA. Of course, the Fib tool will come into effect later. So just to start off, this strategy is best on higher time frames. You can use it on lower time frames because the spread is so big on crypto, on Ethereum, USD. I typically use the higher time frames to give me that extra, we'll call it wiggle room, so that my spread doesn't really take me out or stop me out during my trade. A couple key notes you want to make sure you have a good understanding of is your moving averages are your friend. They're going to tell you what kind of environment you're in. If you go out to the daily time frame, you can see we're in this bearish market, and we have been for quite some time. And you can tell by the direction of your EMAs, starting back here in May of 2022, roughly, you can see all moving averages kind of came together and pushed us down to a bearish market. A little bit of a rally up here in a consolidation phase, we'll call it. But for the most part, we're in a bearish market. Now going back to the hourly time frame, that's my favorite time frame to trade on. You can see here that it goes bullish and bearish many different times throughout the course of a day or a week even, because of the smaller time frame. So this is more of a day trading strategy, definitely not a swing trading strategy by any means, but there's just a few basic things you need to understand. Which environment you're in and market structure breaks. It's as simple as that. So I'll start with this price action right here. I want you to notice a couple of things, and I'm going to draw a quick horizontal line right here. And what I want you to notice is you have multiple support and resistance, 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 resistance. Even that would be considered a resistance, although it didn't touch, it rejects that level. And then resistance becomes support, support becomes resistance, support, support. Then finally we have a break. And that's what we're looking for. So I'm going to remove that. So we're in this bit of this price action right here. What we notice is we previously came from this bullish environment, and we can tell it's bullish. We can tell it's bullish because of the 14 EMA is above our 50 EMA. As long as the 14 EMA is above or below your 50 EMA, that dictates which environment you're in. Above the 50 EMA, you're in a bullish environment. Below the 50 EMA, you're in a bearish environment. So again, we begin this bullish, temporarily bullish environment. We hit this resistance zone right here, and we start to backtrack. And we start to backtrack and fall down, and we'll see what happens next. So we have this resistance zone up here. Price comes up, fails to break through, comes back down, and our first bit of structure break happens right here. Price just ever so slightly breaks resistance or breaks support right there. You can literally almost barely see it, literally by probably a point. But a break is a break before it does a small retracement and then clearly breaks our support. So we have a shift in market structure. We went from bullish, now we're in a bearish market zone. And what happens? You have another EMA cross. So bullish EMAs hit resistance, change of structure, bearish EMAs. Now where our setup becomes clear is when you have your Fibonacci tool. And again, it all becomes part of market structure. So we have this bit of market structure breaks clearly. It does not become and retrace into that resistance before it continues. We have another new low here, and that's what becomes support from previous resistance, and then it finally breaks. So this is where our price becomes interesting. You can delete all this, it's irrelevant to us now. So we have this bit of market structure break. What we do, this is as simple as it gets. Bearish market structure, grab your Fibonacci tool. We grab the leg that breaks market structure, which was this last retracement. It broke all these lows. It broke this low. It broke this low. And eventually breaks this low, but breaks these two lows. Now what we're going to do is we're going to grab our Fibonacci tool, because this is a leg that broke structure. We grab it and we pull it to the lowest part of that leg before we have a retracement. And what do we notice? We notice we have a 62 retracement in confluence with our 200 moving average in our bearish market structure. And so now we're looking to place sells. And all we do is we place our sell position typically on the 62% retracement. It just barely missed, but it was in confluence with this 200 moving average. So it's a very strong level. And so then we just place our sells there. You know, just imagine, you know, just kind of get ahead of it and put it right on the 200 moving average. What I recommend for beginners in terms of price, stop loss and take profit, for beginners, I would recommend just putting your stop loss right at the 100 retracement level. If it continues to hit that 100 retracement, chances are it's going to continue to reverse on you. And then your take profit level is going to be your first support zone, which would be right there. This would be actually an invalid trade. I would suggest for a beginner, because your first support level is a negative risk reward ratio. It's a 0.79. You want minimum 1-to-1. Or a rule of thumb too is you can just go immediately to 1-to-1, which would be right there. Clearly this one just demolishes that risk reward ratio, but you want to use your support levels. They're your friend. Those are your target goals, support and resistance. And then your next goal would be the 0 line. And then from there, you just want to use previous price action. Where does price go from here? Well, from here, it can go down to this level, support, resistance, support. From here, you can go down to this level, previous support. And as you can see, this just keeps on falling and falling. So had we caught this trade, it would have been a perfect trade up to a 10 to 1 risk reward, which was absolutely insane. That would be an insane trade. And that's as simple as this strategy is. I'll continue to make updates on this strategy as time progresses and show you guys my results with this strategy. But I wanted to show you guys exactly how this works. Again, you have a clear market structure break right here. This leg does it. Market structure break in a bearish environment. Went from bullish, reversed, support, market structure break using this leg. You grab your Fibonacci tool from the highest point of that leg using the bodies. I don't use the wicks, I use bodies, to the lowest body of that move, and you wait for your 62 retracement. Again, in confluence with the 200 moving average or any moving average, that just adds more confluence to your bias, but it makes that price level stronger, which reduces it to retrace to that 62 level. So had you got in a couple of points early, let's just even if you got in right here, if the 200 moving average was there as a confluence, creating a strong resistance, you can hop in extra early and start with a 1-to-1. Obviously this trade far exceeds that within an hour, but it's a profitable trade. And that's it, guys. So thank you for watching. Like I said, I'll keep you in up to date with this trading strategy, and I hope to see you guys in the next one.